So if you've watched a few of my Trading the Trap series videos, you'll notice that it talks a lot about how to trade the entries and what to be looking for. But we haven't actually done a covering video on how it actually works and the reason why it works. So this is what this three-part series is going to be. Today I'm going to talk you through the theory behind Trading the Trap, the reason why it works so well on the New York Open, and how to use it in your trading ultimately. Now, if you're like me and you spent years and years kind of failing trades, missing opportunities, then stay tuned to the end because I'm going to talk you through the theory of it today, how to implement it, and I'm going to give you a couple of examples. There's two versions of the trap. You've got a news-related version and you've got just a classic kind of New York Open version. Both of them are highly effective, and in fact, in my testing, they work about 80% of the time. So it's pretty impressive, the stats. There's very few trading strategies out there that can promise you an 80% win rate. So let's get into it. Let's go through. If you don't know who I am, my name's Czech. I run Strong Money Forex. I offer completely free mentorship and coaching in my Discord channel. If you head over to my Instagram at Strong Money Forex, make sure you subscribe to the channel. Pop me a message on Instagram. You'll be more than welcome to join the community. It's completely free. I don't think anybody should ever have to pay for Forex education. So I teach everything that I do completely free that makes me thousands and thousands of dollars every single year. So let's get stuck into it. Okay, so before, let's just delete some of this nonsense. So, before we talk through some examples and show you on the chart how it works, I want to talk you through a bit of a theory, okay? Now, what happens in most markets is there is a accumulation at the start of the day. So the market opens and there's accumulation at the start of the day. And ultimately we have a high or a low that's created usually by London. That low or high will usually hold, okay? It's rare for the London Open high or low to be broken, okay, and it often sets the trend for the day. It manipulates the Asian range and then it will continue in the opposite direction. Now when New York comes in and opens, what often happens is there's a little false move that makes you think that price is going to push higher, and it often will do something like this and it will push a little bit higher. What actually happens is it generates liquidity. It comes and tests a level and then it continues in that direction to make the low of the day. And this little section here is what we call the New York Open trap. This supply zone that's created is often quite valid and will stay, but what happens is this zone here generates liquidity when the New York liquidity comes in the same way that you've got Asian range there. And let me just change the color of it 2 seconds. You've got the Asian range there, and then you have a manipulation of that range, which obviously takes out liquidity. And then we create often a zone that we can trade off here, which is one of my favorite entries. I'll just mark that as blue so you can see it clearly. Okay, and then often in London Open, we can get a nice short. And it's great to hold it to, New York will often have a kind of a liquidity area there, okay? It's great to hold it to there, and that normally creates our first position of the day. But then what happens is it gets to a liquidity area, okay? And this might be just like a 4-hour liquidity area or something like that, or an hourly liquidity area. And then what happens is, wrongly so, is traders will come into the market and they say, right, we've cleared out that little bit of liquidity. We've had a push up. We've left behind a supply zone, which we now know is a trap. So I'm going to buy. So they buy from here. They see a little bit of a push up like that, and they take a buy, expecting it to take out the high of the day, or the high of the day. Yeah, in this example, the high of the day. And then they get stopped out. And it's a really frustrating thing that I went through over and over again in my own trading. But actually, what's happening is down here, we have a daily level. And up here, in line with Asia, we've had another daily level. And so we're expecting price to reject this kind of this intermediate level that might be like something like this that we've had the previous day. Okay, let's just say that's to that, for example. Okay, and then we've got our Asian range. And so we expect price to, come in and reject from here. But actually, the higher time frame structure down here is a much higher drawn liquidity like that, And so we've got, daily bearish price action. And what price is more attracted to, even though this causes a reaction, what price is more attracted to is this daily level down here. And so what we can do is one of two things. We can either take a new position like this and we can hold this down to the lows, or we can just hold this position down to the lows. So the New York area that is created, it often creates a supply zone. It's really, really profitable. And there's multiple ways that you can use it. This is a continuation example, as you can see here. Sometimes what happens is you actually have this. So we've got our Asian range, okay, from the day. We then have a manipulation, creating the low of the day. And then we can take a nice trade up to here. Okay, so we've got our first trade out of the day, Asian range manipulation. We've tagged some daily liquidity that we've set from previous days or previous days low or something like that. Okay, and then we've taken out our Asian range. Okay, and that's been manipulated, and then we've come up to here. Now, here is our next daily level, and we'll just mark that on again as a daily. So, in this example, when New York opens at a reversal point, what often can happen is the opposite. So, if I mark that up, we have a nice push up, we have a nice push down, nice push up, maybe a break of the highs, nice push down, and then it looks like we're setting up to go higher, but what actually happens, we get a false move, and we're going to push down potentially some more daily liquidity down the bottom, for example. Now this is the exact same scenario where price is obviously tricking us into going lower. Oh, sorry, tricking us into thinking price is going to continue. But what's important is that liquidity has targets. Once liquidity has been taken, we need to understand that price is likely to trick us into going in one direction or the other. And this is a really common scenario where we get a New York open trap after a daily level's been taken. Buyers come into the marketplace and think, well, it's been bullish all day. Let's hold that up to there. And what happens is actually we are pushing further because the liquidity objective to take out that daily level has been completed. The daily levels are so important to your trading. They are so important to your trading, and you need to pay attention to them. What we actually should be doing is seeing that actually we've got a nice manipulation setup here with a trap sat beneath. And if we take that trade, we're probably going to be more profitable. The other thing that we want to make sure we're paying attention to is, let's say that this is a downtrend as an example. Okay, we've got this daily level there that was created, and then maybe another daily level there, for example. Let's say this is a downtrend. We need to make sure that we're trading our range plays. So if we're going from that previous high to that previous low down here, this is our premium zone, isn't it? So this is our premium zone where we should be looking for sells from anyway. It's so easy sometimes to get caught on the wrong side of the market because we're trading wrong. I would never ever take a buy from here at the top of a range. If I was going to take a buy, I would need price to come retest something like that and then give me an opportunity. Taking a buy from here, you might every now and again miss a trade that does that. It might happen every now and again, but at the end of the day, I'm not going to trade something like that. What I'm going to do is I'm going to wait, I'm going to see it's broken, and then I'm going to trade the new range that was created. So I can then take a sell from up here, because that's now our new premium area, or we wait for price to come back down. But look, we're kind of getting a little bit off track. Okay, the important thing to note is we should be expecting trades from certain areas, and we can use these New York open traps to help get us into really profitable trades. So let's get into a couple of examples. I think the first thing that's really important for us to acknowledge, okay, is the traps and where they occur. So you need to get to a lower time frame. Now, there's a tool that you need to organize these traps and see these traps, okay? The tool that you need is this Asian range. Okay, so it's called Asian range, just pointed at the screen then, Asian range Nico 948, and this is the timing that you need. I don't understand the timing. I think it's on a different time zone. So for me, in my time zone, which is the UK, it's currently 13:37, and the session that I have to use to highlight the first hour, and this is really important. The first hour of the New York Open is where the trap is set, so you need to monitor that first hour. Okay, so 8 o'clock to 9 o'clock a.m. on the Asian range Nikko 948 will set you this box, and you can see it really clearly on the 1 hour time frame. Sorry, on the 1 minute time frame. Now, before I do anything else, what I'm going to show you is I'm just going to highlight everything on my chart, just in case I need these lines for another time. I'm going to lock them, I'm going to hide them, and I'm going to go down to the lower time frame. And the first thing I'm going to do is I'm going to show you how commonly this trap gets blown. So, New York opens. We have an initial push up. We have a supply zone here, which is created. That is our trap. We have a lovely little breaker structure, look. And then we have a sell setup. So everyone's thinking, hey, we've been bearish all day. Okay, we're going to continue bearish. We've come in, we've tested, we've had multiple breaks of structure. And then New York, and this is what catches people out, New York has given us a lovely little supply to trade from. Let's sell from there. So we take a sell like that and we hold it. And do you know what? We might have even got a 2R out. So you might have got something like this if you're a little bit tighter on your entry. But we then expect it to hold down to these lows. And before you know it, we have a retest, push down, another false move. And then the entire area is invalidated. Now, the reason why this happens for this move here, the reason why this happens is because this is a huge volume of orders coming to the marketplace. They know that there's stops. Look at how many stops are set above this level, okay? They know that traders are coming into this thinking this is going to be a great place for us to sell from. So they set a trap, they sweep you out, and then they carry on in the direction that they ultimately wanted to go in, okay? So that's our first trap. So we're 1 for 1 at the moment. Let's go back to the previous day. Now this is a little bit of a different scenario. I'm going to talk you through how directly you trade these, like I said, okay? This is a little bit of a different scenario, as you can see. But we have New York open, we have an initial push down, and this one, it actually holds quite well, to be fair. That will be because it's taken out some liquidity to the left in this example. We have actually got quite an impulsive move. Now, I held this like this. I actually took this trade. I got out my targets above my Asia play, and then price continued to move down. That was a news-related event. What was quite great about this is that it used the news, which was this candle here. It used the news to sweep its trap. This entire marketplace is manipulated. The algorithm is designed, the IPDA, the International Price Delivery Algorithm, okay, which is on every financial market, is designed to trick you into trades and to take your stops. It's designed to headhunt orders and order volume. So that would have been a good trade if you'd got into it, which is great. But what we have to be wary of is this area is likely to have been blown, which, as you can see, it was blown later in the day. Okay, so that one was cleared out. That's 2 for 2. Now, number 3, down here, this one, as you can see, is actually held. Depends on what you frame it up as, because there's 2 trains of thought. You could either use the initial one, which we've got here, which, as you can then see, is blown. Okay, that's the first supply that has been tagged, and in fact, ignore me completely, that is the trap. Yeah, okay, so we've got an initial move, we've got a continuation of pricing down here. Okay, we've had a trap set, which is that manipulation part there. It's not the cleanest of ones because there's not really, there was a little imbalance in there, but it's tiny, as you can see. Trap was set, we came down, we retested this low here, and then we took off. So if you got into that little supply there, you'd have taken out some profits. But what we'll be looking for is usually a manipulation of that daily level. That would be a daily level because it's a swing low. Yeah, daily level manipulated, and then ultimately the trap is blown. So we're currently 3 for 3. I'm going to talk you through a couple more examples. Okay, exactly the same scenario again as the day before. Supply zone, trap set. We've got a retest of that zone, which is there. We've got a nice trade down to here, but this time it does actually liquidate. It's liquidated. Now, this is how we use it. Now, that is a perfectly valid trade that we've got there. Okay, we've got bearish marketplace, perfectly valid trade. Let's just zoom back quickly. In fact, I'm going to just talk through this one perfectly. let's have a quick look what we've got going on here. So what have we got? We've got an efficient price area there, okay, which is that daily level. That's our EPA. Price comes and tags it perfectly, as you can see. Let's mark that on as our EPA. We've then got, and if you don't know what EPA is, go and have a look at my last video, okay. We've also got balance. That's resting on that EPA. That's where price becomes efficient again. So we've got a couple of reasons to go long. We have then got down here, as you can see, a liquidity area, which we've then tagged pretty clearly. Now what I'd be doing in this instance is I'd be looking at my lower time frame and thinking, right, we've cleared out some liquidity that's sat below that low. Okay, you can see that low is worth paying attention to because it tagged our EPA line, our efficient pricing. We've then had a move down after New York opened, and we've had a really lovely ISC candle like that. Push up, push down, push up, manipulation. And what I can now be doing is taking this trade off that manipulation. We've got that engulfing pattern there, and then I can hold it through the liquidity of the trap. For me, that's how I trade them. I wait for the trap to be set. Now that move is perfectly valid. I wait for the trap to be set because usually the trap will indicate higher prices in this instance. And then if we play it on, did we get any more liquidity out of the marketplace before we got to break even? Yeah, we did. Okay, so we've got a couple of liquidity areas sat above. We've got one here that we got out. Got one here. Let's see if we get that one. And this is just a really good example as well to illustrate what I was talking about. No, we didn't. Okay, how that those London opens hold. So if we look at this here, okay, that was our liquidity zone here. Let's mark that one on. We've come in, we've taken out the trap, we've then had a pull back after the trap's been taken, and then we've taken our next trade here, which is 4.4R. But you see how the London Open holds, and that's a really important distinction. You'll find that most of the time during the day, the London Open will hold. So New York zone, trap blown, New York high, sorry, New York, let me start again. New York trap open was blown. That you can clearly see is blown. You don't need to zoom in on it. The high of London, however, held. Okay, let's go back to this one. Look, this isn't always going to happen. You're always going to have times where this, obviously, of course, doesn't happen. This one here, the London low has held. This one, there wasn't a trap because there's a massive news event. The trap would have been here. After we get a day or so after the trap, by the way, don't pay attention to it. Just delete it off your charts. We want it really blown in the same day. Okay, let's have a look at this one. London Open low has held. New York Open trap has blown. And this is a good example of the one I explained to you at the start of this. Let's use our replay tool. Just come back to this part here. Let's take a look what daily levels we've got to the left. I can assume that we've got something. In fact, we haven't, by the looks of it. We've got anything on the 4 hour? We've got a level there. Let's see if we've got any range liquidity or anything like that. Okay, so this is our range. Okay, let's get rid of that EPA because we don't know that's EPA yet. Mark on our range liquidity, external liquidity, which is there. Mark on our external liquidity, which is here. And then here, we've got our range liquidity. So this is a really good example of how we can use this trap in our favor. Drop down to the 50-minute time frame. So we've clearly got really bullish pricing. That is a rejection of some sort of daily level. You can see it very clearly there. Okay, when you get these great, fantastic moves that kind of push and react, and then push and react really sharply, they're great moves to see that liquidity's in there. And what we can often then look at doing is using these areas to then look at, more pricing to be swept. Because if we've got an area like this that sweeps out a daily level, that's now an area which itself should be swept. So what did price do? Came into London, we set a low of the day, which is obviously held. That would have been a great first trade of the day. Get into that like that. We're still in our discounted area, just about. It's at equilibrium, maybe a little bit higher than we expected, but after this move here, maybe when we consider, it's not technically strictly to my plan, but it's definitely a valid trade. We then had a sweep of the range liquidity, beautiful sweep of the range liquidity, a couple of tests, as you can see here, and a retest. So that's our ISC, a retest of that ISC. And what I'll be doing is I'll be setting the trap like this. So low to the high, that's around the New York Open. And we take our first trade after the engulfing on the 1 minute time frame would be like that. We set the first profit target to the trap being blown. That's our 3R out, we're happy. And what's probably going to happen is this now is going to take out our external range liquidity, because as we discussed, price moves from liquidity area to liquidity area. So if we zoom in, let's see if we get it. In fact, no, we go higher. So in this instance, it hasn't quite got the full down, but you can see how you can use that trap to get yourself into a really clear trade. That London Open has held all the way through. Okay, we can then be looking at this and thinking, do you know what, if you're brave enough, you could be taking higher prices. The very next day, we had, you know, a manipulation, retest, our London Open, and then if you got into that, you'd have had a great trade. News would have taken it up there, which is fantastic. But you can see how powerful this can be. Knowing that the area that is created in New York when it opens is highly likely to be swept. When you've got other manipulations like range liquidity being taken out here, which is the last high in a range before the external high, that is now a really safe and valid trade. So I'd advise you all to go and test this out. Test this out. Go onto your charts, draw out the New York Open, and just see how many times, if you draw it out, it gets blown. That one's actually held, which is rare. This one here, that one's held. So we've had a couple of holds, but you know, these past ones we've all had blown. This one here, that one's held. We've had a bit of a rough time in terms of the New York Open trap. This one, there's not really any manipulation around it, but that did blow. This one here, that one's held. Okay, so that one's held. Again, so has the London Open. This one here, blown. This one here, blown. This one here, blown. You see how price will come down to it? Actually, this one's just been tested pretty perfectly, to be fair. Has it just been manipulated? Yeah, it's just been manipulated. Look, just below there. That one's blown. This one here, blown. This one here has blown. I don't think you need me to go through any more. You can probably see as you go through the charts how commonly the New York Open trap has been blown. Okay, and almost every single time New York opens, unless there's a big news event that holds like this, okay, almost every single time they're blowing. What's really interesting though is how the London high will typically always hold. So you've got two now biases that can really help you when you get into your trading. Okay, this one is the opposite. The New York one has held and the London one has blown. Okay, so obviously there's always going to be times where it doesn't work, of course. This one has held, okay, as has London. So the London high and the low is a really powerful one, but what you'll often find with London highs and lows is that they're often targets that cause, look at that. So if I can just zoom in enough so you can kind of see it. So that low of London, look at what it did to price when it came back to it, and look at what happened when it retested it. So the London low is a really important one as well. Okay, again, same here. Let's just mark that one on. That's the lower London that day. That one held, as you can see. However, the New York trap was blown, tricking people into thinking that it's going to go bearish, bullish, and it's blown the trap and then it's pushed away. Let's see what happens on this level. So this level we've just drawn out, look at how price reacts to it. The London Open price is a really important one as well. You can see price has kind of played around on it. Every time it's come to it, it's been mucked about, and it, you know, causes a reaction. It's caused another reaction there. It's caused another reaction there. So that level 1.052 is a really powerful level. So these are all things that I consider in my trading. Okay, as you're going through the charts, keep an eye out for these areas. This is a perfect example of a news related one. New York Open trap with a news push. It's come out taking some major liquidity to the left, as you can see. taking out all that liquidity, and it's pushed back up. New York open, trap, blown. I mean, I could do a whole video of just New York open, trap, blown, London held. So that should be enough, guys. Look, so start testing this, use this in your trading. It's really, really powerful, really, really important. If you're not factoring these things into your trading, you are putting yourself at a disadvantage. If you're not doing so already, please subscribe to the channel. Any questions that you have, pop them below, and I'll catch you in the next video. Thank you.